All right, everybody. Hey, welcome to Note Night in America. Glad to have each and every one of you join us live here on Zoom or watching it live on YouTube or catching the replay. We're jacked up to have you. Welcome. If this is your first time, welcome. We're glad to have you. We host these webinars every Monday night for the most part for the last 11 plus years now, doing at least 35 of these every year. So a wealth of information on specific subjects that will help you in your, not only in your note, but also your real estate investing business. And tonight's no different. We've got a really great topic tonight that I think a lot of investors forget about or really don't pay attention to. And we've got a rock star on here to help explain some stuff. But before we get to the meat and potatoes, little housekeeping for you guys. If this is your first time, make sure to let us know that you're here and what part of the country you're joining us from. Yes, we are monitoring the YouTube channel for questions as well as we get through that. So if you're watching live there, don't feel neglected. You can always go to NoteInvestors.com and register for the Zoom and join us live on here as well, but we'll also keep you. But once again, guys, we've been doing this for over 11 years now. Make sure you subscribe to the Note Night in America podcast. We have replays that come out every week. All videos and all these webinars are also on our YouTube channel at WeCloseNotes.tv. You can subscribe there. Along with that, make sure you check out all the other podcasts that we have on any type of listening platform that you have. We're on them all. You can check out our Note Closers Show podcast with over 1 million downloads. And of course, our Note Camp Live podcast as well, which I think we just surpassed the 200,000 download mark on that podcast. So yay, woo, glad to keep delivering content. You keep showing up, we'll keep delivering for you, everybody out here. So we do have a little housekeeping. This coming Saturday, we do have our one-day wholesaling notes masterclass. Yours truly. I've been wholesaling real estate for over 20 years, but primarily buying by my own investment. We are going to be teaching this wholesaling class for those, showing you how we actually will get lists or deals from different websites, be able to control them, put them under contract, and then flip the paper, flip the assets out there. Pretty easy. You just got to be coachable, and we do things a little bit differently with what we do. No, we're not straight up joker brokers. We're actually looking for our own portfolio always, and we'll show you how to kind of take that approach this Saturday, starting at 9 a.m. You can go to wholesalingnotes.com. The replays are included. We'll talk about how to wholesale one-off notes, wholesale pools. We'll talk to you how to build a really true buyer's list or an investor's list, as we like to say. We'll show you how to protect your source and how to control millions of dollars of properties for literally $10. Yes, I'll share the contracts, the paperwork that we use. It will not, you'll look at it and be like, why have I not learned about this sooner? So anyway, you can RSVP for $99 at wholesalingnotes.com. When you RSVP for wholesalingnotes.com, if you do it before Friday, you'll get a ticket to Note Weekend on the 19th as well, normally $99. So it's an opportunity for you to grab one and grab a second one at no additional price. So we'll talk about wholesaling and do more of our Cliff Notes version of training at noteweekend.com on Saturday the 19th. So just sign up, wholesalingnotes.com, RSVP your spot. Spots are filling up fast, ladies and gentlemen, and take advantage of that right now. But anyway, any questions, comments, concerns about any of that stuff? Hope you are all doing well. I mean, what part of the country you guys join us in? If you want to type that in the chat roll, I see Larry Hoffman back, a little jet lag, probably from an early 7 o'clock flight this morning. Back in Cincinnati, I see Phil. I see RJ from New York. Robert Slater, good to see you. Joseph and Richard Fabitz from Chicago. What's up, guys? John, Joe, Gerald, Andrew. Hey, buddy, good to see you. Good to see some familiar faces. And John Sherry from Rochester, New York. Hey, bud, good to see you as well on here as well. But anyway, let's get it rocking and rolling here on tonight's topic, okay? Because this is what you guys are showing up for. And this is going to be something I'm sure you're going to have plenty of questions about. I know I always like to ask questions when it comes to it, but without further ado, let's get in and bring on our special guest tonight, all right? Now, this rock star who's taking time out of their busy schedule to join us tonight is an expert. They have over 15 years of experience in the commercial and investing experience. She's the VP of sales for J.B. Lloyd and Associates. She used to be in charge of all their marketing beforehand, before being promoted to vice president. Like I said, has over 15 years experience in commercial insurance. She works with a variety of investors, realtors, insurance agents all across the country as well, over 400 of those. I guarantee that number is a lot bigger, especially the night helping people from all across the country. You may have seen them at a trade show, the Note Expo, a variety of different mortgage banking conferences over the years. She calls Austin, Texas home, on the south side of Austin, as we like to say, maybe to keep Austin weird side a little bit. But honored to have Beth Boisseau-Coots join us here on Note Night in America. Beth, what is going on? How are you doing on this Monday night? And I guess I got to bring your camera back on there. I'm going to ask to unmute you. And then I'm going to ask you to start your video up. And then I will stop my share so you can take over. Lady, she's there. All right, let's try this one more time. Ask to unmute.
There, can you hear me?
I can hear you, and then I'm going to ask you to start your video. I'm sure you were just like rocking out the journey with me there for a few minutes.
I was. Okay, so start my video. Yeah.
Go. Perfect.
Did I do it?
Yes, ma'am. We can see you. We can definitely see you.
You can see me, or can you see my screen?
We just see you. We just see you right now. So if you're going to share the screen now, then what you would do now is hit the share screen button to pull up your PowerPoint, and we'll go from there.
All right, just give me a second here. I can talk about insurance all day, but
it's
working a computer may be a little bit more than my pay grade here. Hang on.
That's okay. That's okay.
Okay, I'm back. Share screen.
There you go. Yeah.
Ha.
Looks like we're working there. There we go.
Looks like it. Yes.
If we just put it in presentation mode, I think you'll be good to go.
There.
Oh, look at that. See, you're good at this.
See? Yeah. Yeah. Maybe I'll change careers now.
Well, one thing I know we're going to get to here is especially on the note business, but Beth, you work with a variety of different, like I said, investors, agents, and stuff all across the country. And you're going through some stuff here. Guys and gals, let's hold your questions till the very end, because I guarantee Beth will probably answer them as she goes here for you. And then we'll have plenty of time for all the questions you have at the very end. Right, Beth? Yes.
And I love questions. And I love it when you guys surprise me. So if you can think of something that hasn't been asked before, that would be amazing.
All right. There's a challenge to you guys to keep in mind there for you. So Beth, I'm going to jump off my camera here, so it's just you, but I'll be here monitoring, and we'll go from there. Okay.
Okay. Sounds good. Thanks, Scott. So insurance basics for real estate investors. And I've was happy to receive.
To keep in mind there for you. So Beth, I'm going to jump off my camera here. Sorry, that's why I have my Bluetooth on. So you're good. My bad.
Okay. We did win this. We were voted the best property insurance company for real estate investors 2 years in a row. Super honored about that. So the big question comes to me, why do I need to pay for insurance? Oh, the insurance companies, they never pay. I pay all this premium and, I never get, rewarded for it. Well, this is a little bit of a reminder here. Whoops, sorry about that. Just the losses that this country has sustained in property damage since 2017. And as you can see, this last year was actually the third biggest year in terms of losses in this country, 145 billion from natural disasters. That was actually third. That was behind 2017, because if you adjust 2017's 140 billion for inflation, it was actually higher than 2021. And then the first highest was 2005. In Texas, and Scott can probably attest to this, we had a winter storm last year that by itself caused 10.346 billion in losses in the state of Texas. The storm wasn't specific. I mean, it hit other states as well, but we suffered greatly from it. Our infrastructure really couldn't handle it, and there was a lot of property damage.
So there was. You talk about having ice for 7 days longer than we're used to here in Austin, Texas, and then power being out for so many things, and below freezing temperatures, pipe bursts, and things like that. I'm actually kind of surprised that number's not even higher. You know what I mean?
Oh yeah, I mean it was a tragic event. It really was, and one that we won't forget. So this year came in second, as I mentioned. to 2022 in terms of number of disasters, 20 versus 22, and third total behind 2017 and 2005. And here's just a nice little shot of some of the disasters that we get. In Texas, in Texas, Florida, Oklahoma, all the Midwest states, we see a lot of wind. I know when I lived in Dallas, we lived in this particular house for 10 years and got 3 new roofs. And then Texas also sees a lot of floods, as do other states. California, Colorado, we see a lot of fires that come along. And here's just a nice little graph for you guys to look at. As you can see, everything's trending up. So, again, if it's not a matter of if you'll need insurance, it's a matter of when. So it's important to have. So the meat of this, what you need to know. What the world I deal with is with a lot of real estate investors, and within that group, there are a lot of different subsets. We've got the note folks, the people who are buying distressed mortgages. And we've got the fix and flippers, those who are purchasing properties to rehab them and then resell. We've got the buy and hold people. They're buying properties for the long game. They're going to rent them, pay them off quickly if they're not already paid off, and use them, as an asset toward retirement. As also, a longer wealth building program. Then we've got, the people who do the wholesaling. And then there's a mix of all three. And I seem to notice that people often they start out as note investors, and then they become fix and flippers, and then they become landlords, and then they start doing wholesaling. Then they get into doing the Airbnb, and then it starts all over again. So it's definitely something that people don't stay in one subset, rarely in my observations. So we have different types of insurance programs that we can use to work with people as they grow and as they diversify in their real estate investing. So that brings us to this slide, which is, what is a master policy as opposed to an individual policy? So I don't know how many of you guys, how far along you guys are in your journey with this, but a lot of times people will say, oh, I went to so-and-so and I got a policy for this property. And it's just one single policy for that single property versus a master policy, which is it's on a reporting form. So once the policy is set up, people are able to add properties to the policy as needed and then take them off as needed. So if they've got 10 notes and 5 of them don't have insurance on them, or they can't prove that there's insurance on them, the borrower won't get them that declarations page, then they can just add them to their master policy. And then if they sell the note, or the owner is able to provide that proof of insurance, or they foreclose on it and it becomes a rental, they are able to take it off. So it's just sort of a convenient way to manage the insurance on multiple properties in one place. And typically, these master policies are administered through an online portal, which the user then has access to and can do the adding, deleting, and changing, running reports, and printing out notices of insurance and the like. So another thing I hear a lot about from the real estate investors are, what is the difference between a real estate investor policy, a master policy, and a forced place master policy? And there is a difference. So with notes, if it's not a contract for deed, it's strictly a note, you need a forced place policy. That means that you are the lender and your borrower has not proven that they have insurance, and you need the ability to put on insurance to cover your interest in that property without being the owner of the property. A real estate investor policy is very, very similar to that, but you are acknowledged as the owner. And with the real estate investor policy, you have general liability automatically on every property that you add to that policy. A real estate investor policy gives you that, as well as the ability to add different types of investments on. Again, it will depend on the carrier, but you can add the fix and flips. You can add the buy and holds. Some of them will allow Airbnbs and the like. With the forced place policy, general liability is only added to the property when foreclosure has started. So once that property is changed to a vacant property, an REO, then the GL is added. So it's a very important distinction to know the difference. And also to know that once you start doing the contract for deeds and your name is on that deed, you need to be looking beyond the forced place and to a real estate investor policy, because you have the exposure there in the general liability. Another question I hear a lot about, or I get a lot of confusion about, I'll put it that way, is what is the difference between a basic form policy and a special form policy? I'll have people come to me and say, oh, I have this policy and it didn't pay the claim and I'm so mad. And then I'll look at the policy and I'll see that it was a basic form policy. And that's great. That does give you some coverage, but basic form is just that. It's basic. You are only covered for what is listed on that policy. So usually it's the 5 basic perils, and often it's endorsed to include theft. That's 6 things. Anything else, it's not covered. Of course, you see that in the rates, in your premium, it's going to be less. Whereas a special form policy, it's going to cover everything except what is listed as excluded. So it's the opposite. So everything is covered unless specifically excluded in writing on this policy. And of course, you pay a little bit more, but you can sleep at night. So it's important to know the difference between those 2 terms and what they mean and how that will affect you at the time of a claim. Again, basic form covers only what is listed on the policy. Special form covers everything except what is specifically excluded. Here are some of the named perils that you will often find on a basic form policy, and those are vandalism, theft, vehicle damage, rioting, fire or smoke, aircraft damage, lightning, windstorm, volcanic eruption, and explosions. And, if you look at this, what's missing? Well, what about hail? That is one of the #1 things that we get in terms of claims, hail. It's not on here. What about flood? What about burst pipes? Ordinance of law. So there's a lot of things that would fall through the cracks and you wouldn't even think about it. Okay, so this next slide, this is actual cash value versus replacement cost. Now we're talking about the settlement. So you've had your loss. Let's say, you live in Dallas or Oklahoma, or your properties are there, and you have a tornado come through, roof's gone, and you need to settle. So the insurance adjuster comes out and you are told then, okay, well, this policy is an actual cash value policy. What that means is they take the replacement cost, so that's the cost to replace or repair with labor and materials. They deduct depreciation. It's all done through a system now, it's all seamless, and the adjusters they just put it into the system and it spits it out. That depreciation is based on the age and condition of the item in question at the time of a loss. So this property, the note you have, the roof is 30 years old and never been replaced. That's going to be much more depreciation that's going to come off that replacement cost. So you're going to have the depreciation, and then you're going to have your deductible. So that's what actual cash value means. And this says here, it's a little blurry, but it says actual cash value covers coverage pays you what your property was worth at the time it was damaged or stolen. So it is replacement cost less depreciation. Replacement cost is what it costs to replace it, regardless of the condition it was in at the time of the loss. Obviously, replacement cost is better, but it's really something to be aware of and factor into your business decisions when looking at, the cost versus the benefits of your insurance plan. Coinsurance it's a bad word. Nobody likes coinsurance. Nobody understands coinsurance. I'll put it that way. The best way I have come to describe what coinsurance is when a property is underinsured, the carrier at the time of loss will deduct approximately the same percentage of that you are deficient underneath the replacement cost. So if you're insuring it for 50% below what the replacement cost is, your settlement will reflect that 50%. Now, there's a kind of a easy way to put it. There is a formula involved. This says, it's a contractual provision that often appears in property insurance contracts. It is to encourage the insured to insure the property to a stated percentage of its insurable value, usually 90%. The insurable value of the property is the actual cash value, replacement cost, or some other value described in the valuation clause of the contract. And that's a bit of a misnomer. It's going to be replacement cost. They typically want to see 90% of replacement cost. This isn't as important to know if you're strictly forced placing, because at that point you're covering typically the interest you have in that property. And that's usually the loan balance. It is very important to know once you start foreclosures and get into that whole game, because I'm sure most of you know this, but if you don't, once you become a note investor, you eventually will have a foreclosure. And at that point, you need to know what coinsurance means and how to insure your properties. We won't get into this too much. If anybody is interested in knowing what the coinsurance formula is, I can email this. So here are some of the frequently asked questions that I get. One, can I have multiple LLCs covered on a master policy? And the answer to that is yes. Every carrier I work with allows as many LLCs as the investor owns to be covered on the master policy. They are all just added as additional named insureds. How to break that up, or which one to put as the primary, is something you would ask your real estate attorney. I wanted to say real estate investor attorney, but I don't think that would be correct. 2, can I add a lender to a specific property or properties? Now, I don't know how much this would affect notes. Probably if you're dealing with wholesalers or private lenders, it may, but yes, the answer is yes, you can. Is there a limit on the number of properties I can cover on a master policy? No, there is not. Now, I will say there is a minimum number of properties that you need to have in order to get a master policy. That number varies with each carrier. The minimum is 3 with one of my carriers, and then one of my other carriers, their minimum is 10. So it depends. How do I add properties? Most carriers and MGAs, insurance people that are in this world, have access to an online portal that gives you the ability to add and delete properties as needed. Can I add, or do I need an umbrella policy? Can I add? I'm not quite sure what I was thinking when I wrote this. This was about a year ago. So I think what I meant was, can I increase the limits on my general liability, or do I need an umbrella? So the answer to that would be, you would need an umbrella if you feel that you need more general liability coverage than what is on the policy. Most of the policies have $1 million per occurrence per property, $2 million aggregate per property per year. Some of my clients feel like they need more than that. Seems like 3 million additional is a sweet spot that bumps their limits of liability to 5 million. And for those of you who are wondering what GL is, general liability is, I'll just say it because I do actually get asked this quite a bit. General liability coverage is triggered when an insured becomes legally obligated to pay damages for bodily injury or property damage. This could be your the tree on the property you've invested in is blown over in a windstorm and puts a hole in your neighbor's house, in the neighbor's house. You are legally obligated to pay that damage. Or let's say you've got a realtor touring the property and there's a rotted step leading to the front door. Their foot punches a hole through that and they break their ankle. You are legally obligated to pay property damage or bodily injury. So general liability is really important, especially once you start the foreclosure, because you are exposed, or if you do the contracts for deeds. Number 6, are properties covered when they are under construction? It depends on the policy. Some of them are, some of them will, some of them won't. If they won't, then what you need to do is carve that out and get a builder's risk policy. And again, this may not apply too much to the note folks. However, like I said before, I've been in this game a long time, and inevitably note investors end up doing rehabs. So is there a vacancy limitation? No, there is not. With forced place and real estate investor policies, there is no vacancy limitation. You can have it vacant for 90 days, 190 days, or 90 years. They don't care. And finally, do you cover properties in Florida? And that is such a loaded question. And I do get it a lot because it's a popular place to invest. We can cover them. It is not always competitive, but we can do it. So it's again, the infamous words in the insurance business are, it depends. So it depends. And I like this because living in Texas, as Scott can attest, we can have all 4 seasons in one day. So this just illustrates that.
I think that's weather from last Thursday, or
yes.
Wednesday. It was like 80 degrees and then dropped down to 32.
It was 85. Yes, yeah. Biggest drop in Texas history. Yeah, I know, it's crazy. And this is my contact information. If anybody ever wants to reach out or has any questions offline that they didn't think to ask, or if you wake up riveted at 4 a.m. and have a burning insurance question, email me. Don't call me, email me. So you can call me after 8.
That's right. Don't call before 8 a.m. Hey, do you mind leaving that up for a little bit?
Oh, I'm sorry. Yes, of course.
Yeah, no, that's fine. Leave it up for folks to grab, take a screenshot and go from there, because I know that they'll definitely grab it based on who's on here for sure.
There you go.
There we go. So one of the things, you hit the nail on the head there, Beth. Definitely, we as note investors start off, with a policy forced place, and then obviously through a foreclosure or a deed in lieu or cash for keys, that property now gets deeded back to us, the bank, and we've got to change the policies that are on that. Correct?
Yes. And all of a sudden, you're a landlord.
Yeah, exactly. Or maybe not a landlord. You don't want toilets as a trash outs, but maybe a rehab policy or something like that. Definitely.
Yes.
So you're not dealing with that stuff. But what are you mentioned Florida there? Is Florida one of the more expensive markets you see? If you're near, for investors, with everything that's going on there with the hurricanes and stuff like that, for the most part, or is it vary in different parts?
No, Florida, period. They don't really distinguish. With Lloyd's London, the minimum rate for residential is $2.25 per $100 of insurance.
Wow.
Some of the other carriers will go a little lower, especially if you've got a big portfolio or if your portfolio is spread through other states as well. But it doesn't, I mean, it on the low end, I would say I see it at maybe 90 cents per 100. And on the high end, 250 per 100.
Okay.
Yeah.
Somewhere between 1% and 2.5% basically of the asset then for the most part. Now that's an important thing to keep in mind too, especially when you're buying non-performing notes or notes out there, because that's an added expense. Now, are folks paying that all up front, or is it paid half up front, monthly basis? How's that kind of work out so people can budget that in?
Okay, so that's a very good question. So we offer monthly and annual billing. We charge with most of our carriers and our own carrier, which we own our Lloyd's syndicate. We charge monthly or annually. We have a few carriers that will only allow like a minimum of 3 months. That being said, most of the carriers also only charge for what you use. Even if you pay annually, you would still be refunded at, if you were to sell it after, 29 days or whatever, you'd get the rest back.
Or be able to provide proof of insurance from the borrower in a lot of cases, right?
Oh, absolutely. Yes. And that's a law. If you come back and show this whole time the borrowers had this insurance, look at this, I have proof now. All of that has to be refunded by us and by the investor.
Yeah. Now, forest place insurance, before everything happened a decade ago, was it the normal cost for forest places that a lot of banks would triple charge a lot of times, whatever the costs were? And that's changed with everything too, hasn't it? You can't really jack up the price for FPI like you used to be able to, right?
No. And they shouldn't have been doing it even then. None of our banks did, but it came to light during the financial crisis in the late 2000s that was happening. There was not only the predatory lending, but the predatory, insurance. And the banks, they were, again, I didn't have the experience with any of mine, but they were pocketing this excess premium. And that's, predatory in itself. So, yeah, no, you cannot do that. Dodd-Frank changed that. And
Exactly.
CFPB will not allow that.
Yeah, for those that don't know, CFPB, that's the Consumer Finance Protection Bureau. And you don't want to fine with the CFPB because their fines pretty much start off pretty steep in a lot of cases. If you have a complaint from your borrower, in a lot of cases, they're for you.
They don't have a sense of humor. Don't mess with them.
Yeah, exactly. They do not have a sense of humor. So Larry asked a question. He goes, just thought this. I have a non-performing note that's becoming performing. My borrower just signed up for insurance. Is it still a good idea to have additional insurance on the note like FPI, or is it overkill? Good question, Larry.
This is a good question. You would need to look at how much he has the property covered for, and make sure that it's replacement cost, and make sure that Larry is added as the lender on that policy.
Now, could Larry still want to go out if it's in a high risk area? Could he still go out and have a separate policy so there's multiple policies on the property? Is that something you see done anytime?
What I see that done some, yes. I don't necessarily think it's something that needs to be done.
Right.
What I see more often is investors, especially as they grow, will have a liability policy over all of their properties. Just straight liability, not even connected to the master policy if they're using one. So.
And what will that cover in a straight liability policy? What are some of the things that covers?
It covers them if they're sued.
Oh. Yeah. Cool. Is that something you can help me with? Larry says, yes.
Of course.
That's why she's on here.
It depends.
Good stuff there. Now, with you guys working with so many different investors out there, and you're working, you said, some of your just not almost say distributors, but some of the insurance companies will do a master policy with as little as 3 and average. Some will do 10. Are there some things that people need to think about when they're buying in multiple states? Like as far as having a point of contact within a specific amount of miles, or a property manager, something like that. What do they need to keep in mind when they're looking at buying in multiple states and insuring with you?
Well, I mean, from our perspective, not being a note investor, we do have buy and holds, but I would say, it's always a good idea to have point of contact, a real estate person that you can trust, a lawyer you can trust, an accountant you can trust. I'm not sure you need to have the lawyer and the accountant in each and every state, although you may. You probably actually know that better than me. From the insurance point of view, I would look at the crime rate in the area that you're looking at the property in. I would look at weather patterns and losses. That's a biggie. If it's going to be something where, there's a lot of crime, or there's a lot of natural disasters, floods, wind, it might not be the best investment for you, or it might be. It depends.
But it's what you're buying that asset at, for sure.
Right. I mean, I wouldn't buy all of your properties in Moore, Oklahoma, because you're not spreading your risk. There's one tornado that comes through, a bad one, and you're done,
Yeah, exactly. Or like all in buying properties that you're rehabbing in the south side of Chicago, where crime is pretty rampant in a lot of cases.
Yeah, that's not really a good idea.
Chicago, I hear some scars there a little bit. I know I've had scars from buying in south side of Chicago, and things being broken into, and copper being stripped from the property 3 or 4 times in a row. Yeah, it's not my favorite spot.
We've had the claims. Yeah.
Now, you guys handle, if somebody's buying, let's talk a little bit of some scenarios here. Let's say I'm buying a note in a property. Borrower's non-performing, so I have FP on it. Borrower moves out of the property or leaves the property. We start controlling the property. We find out that there's rampant mold, or they were living in squalor. It needs a lot of rehab. What are some things that we have to, what kind of claims would we be able to go back on and get? There may be some scenarios that you guys have run into before.
We've run into all of those, actually. The first thing in this situation, the first thing you would do as soon as you find that the property's been vacated and it's appropriate to do so, is start the foreclosure process. As soon as you do that, you need to go to your insurance provider and increase the amount of insurance coverage on that property. Because, and some will even let you backdate the increase, because you now have a claim situation. And as long as the property's been on the policy or been covered with you, you will have, or if as long as you switch it to the foreclosed, you more than likely will have your claim paid. But it is very, very important. And then, of course, secure the property, make sure no more, no further damage comes, report the claim, all that.
Now, one of the things that I was going to ask you this on this stuff. Are there specific vendors that you like to recommend out for folks in specific areas? Like I know we've used a company called Dogs before, DAWGS. So it sounds familiar if you know that it make a noise, where they go in and literally put like metal doors over all like the first story entrances and windows that are coming really handy, huh?
I don't have any per se that I recommend. I have some lawyers that I know throughout the United States that do real estate investor legal things, and then different realtors that I work with as well, and property managers. But I don't know any dogs.
Okay.
But I think maybe I should.
Well, they're a vendor. They're a vendor called DAWGS. It's like
that's what I thought. I think I've heard of them. I'm
friends with Dog the Bounty Hunter's son. He's a buddy of mine.
Oh my gosh! Does he live in Austin too?
No, he actually lives out in Idaho now. Actually, Wes Chapman is a great guy, great buddy of mine. Not totally different, opposite side of the spectrum. Instead of the long hair, very put together. but a great guy, great a buddy of mine.
Oh,
But
that's cool.
yeah. Now, one thing too about what kind of difference does it make? Because people looking to get a specific, either especially the note investing side, you have the opportunity to buy basically what the full payoff, let's run some scenarios here. Let's say the payoff on the note's 150, but the house is only worth 100. You wouldn't necessarily insure the property for the full payoff when the asset or the replacement cost is only 100, correct?
Right. No, in fact, if you overinsure, there's problems with that as well, because the adjuster will come out and say, hey, this is overinsured. And the point of insurance is not to profit, it's to indemnify, is to make the person whole. So that it's tricky. You have to really think about how you're covering things. And I always tell people $110 on the low side and $175 on the high side. If you think you need to go above that, let's talk, and I'm talking per square foot, by the way. If you feel like you need more, let's talk, because I don't want you to get into a situation where you're overinsured. Now, that being said, we have a lot of clients that work with lenders, again, because I work with a lot of the folks that are doing the fix and flips and the buy and holds too. And these lenders, they don't understand this overinsurance thing. They think that it should always be the loan amount.
Mm-hmm.
So then I have to go get that approved from the carrier, and it's just a lot. It's a lot of fun, really. Why do we need to insure this 2,000 square foot house in California for $928,000? Well, because the lender said so. So anyway, don't ask. This is my life.
Yeah, don't buy anything in California. It's whatever price anyway. There are better deals elsewhere.
Oh my gosh. Insane. Of course, in Austin.
Yeah, exactly. It's getting close to it here in Austin for sure. Now, question for you here. When you have the option to, how big of a difference in your deductibles that you're going to pay out of pocket, how much will that affect your month to month or your overall policy in a lot of cases? What do you see kind of an average across the board if somebody's got a deductible?
$5,000, that deductible is the most common one I see. Now, with forced place, strictly forced place, that I see $2,500 quite a bit as well. Now, with forced place, you can go down to as low as $1,000. With a real estate investor, you can't go lower than $2,500. And this is not wind and hail. Wind and hail now with almost everyone is 5% or $5,000, whichever is greater of the total value. That actually changed last year, and nobody's real happy about it, including me, because that's a lot. But yeah, 5,000 seems to be the most common deductible that we see. But it does go, it brings your premiums down some if you go to up to 7,500 or 10,000 or even 25,000. And of course, it brings your premiums up if you go the other direction. So
depending on the type of asset class and how clean an asset class, that can have a big difference for you too, and how much reserves and what you're buying that asset for too, in a lot of cases.
Yes, definitely. And how much do you want to self-insure?
Right.
So I want to buy shoes. I don't want to self-insure.
That's right. You want to buy the shoes, not have to sell the shoes to pay for the insurance, right?
Exactly. Yeah. My husband has a very different take on this. I won't lie. But it's all about risk tolerance. So
speaking of shoes, are you guys also providing like renter's insurance if somebody's doing land contracts or doing rent-to-owns or wraparound mortgages? Do you guys also provide that as an option to investors, or not to the investors?
Do you mean
but
for the renters, like
yes,
for the tenants to?
Yeah.
We do not. We used to, but it was not profitable for us.
Okay.
But there are some groups, and I'm trying to remember what the big one they're out of Dallas. I think it's RealPage, maybe. There's a company that does that all day, all the time. They've got it down. They're, that's the way to go with them.
Having somebody else do that for you. What are the big differences you see in residential versus commercial assets? Is there anything different?
Oh my goodness. Yes. Especially, are you thinking multifamily? Is that where we're going with this?
Multifamily, self-storage facilities. We see a lot. I mean, even hotels. There's each asset class a lot, but different. But those are the ones that we see a lot of the distress stuff in right now.
Yes. So as far as insurance goes, we can get all that, and we do. In terms of premiums and the ability to get it, how easy it is. Apartments are hard. They are hard to insure. They are hard to underwrite. Carriers don't really like them. We have carriers that do them, but it's just know when you go into multifamily, the part where you're getting the insurance is probably going to be more painful than the loan itself. So you will have to, and especially if it's older, you will have to tell us updates on every single part of it. You will have to, really dig in there. We need to know what kind of losses has this property had, even before yes, we know you're just buying it. We still need to know what kind of losses. Get all the information you can. What kind of updates to the electrical, HVAC, roof, plumbing, all of it. We need to know that. If it's over 26 years old, you have to understand you will not be able to get, especially in Texas, replacement settlement. And you will not, very, very hard to find much. I mean, sometimes we have some that'll do special form, but man, just know it's hard. So
it's almost easier to get it on a new build than it would be on an existing.
Ooh, so much easier. And like I said, I have carriers that'll do it, but the feedback I get from people who are just getting into the game, and again, this is particularly true in Texas. They're buying these older ones. They want to rehab them, and they're like, why do they want so much information? I'm busy. I don't have time to fill all this out. I'm like, I told you this is going to be a bit of there's some homework, and
right.
In order to close, you got to have the insurance. In order to get the insurance, you got to fill this out. So just know that going in.
Right. Question for you. Besides, do you guys also do, somebody asked you online on YouTube, if you guys do key man policies, and I think you guys are more property versus life insurance, correct?
Right. Yeah, we don't. My brother-in-law owns a benefits company up in the Dallas area. He does that all day and all night. There are some really great folks that know that part of insurance real well, and I would not be among them.
Right. So for those that are on here, what a key man policy is basically if you're the key man in a group and you were to die, you don't want the business to go down. So many companies will put insurance policies, or they call it a key man policy, on the key figures of the company. So if something does happen, everybody gets taken care of and made whole, and the investors are covered a lot of times. So,
and it's a good thing to do. I
Right.
just not one to do it. So my expertise is banks and real estate investors.
What's the craziest claim you've ever seen in your 15 plus years there at Lloyd's?
The craziest claim, it wasn't even mine, but the craziest one I ever saw was a investor. He was my client, but prior to becoming my client, he was sued because his tenant had bed bugs, which he treated, and then the bed bug treatment made the family sick, they said, and they sued him and they won.
Oh,
so that was the craziest. The one that shocked me the most that happened to one of my clients was they had to get like 26 new roofs from a single storm.
wow.
Yeah. So that hurt.
Yeah.
Everybody.
Now, question here too. Are you see a few years ago, and I don't know if it's still going on, but you often saw sometimes roofing companies trying to commit a little bit of fraud to get things paid for. Have you seen any of that taking place?
We don't, we file the claims, but once we do, it's outsourced.
Okay.
So I don't really get into that part of it. Of course, we always say go with, and so many of my clients have their guy or their people. So, I think that's probably more like the individual, the residential homeowners side of things.
Makes sense there for you. What's the thing that drives you insane when it comes to claims? Anything that just like, oh, come on, you should have just done this to make it a little bit easier on you?
Nothing really. I always feel bad for people because, this is not something anybody wants to deal with. So, claims don't bother me. Lenders from New York.
No offense to RJ or anybody on here.
Nobody. I love my New York friends, but man, sometimes those hard money lenders, they can really give me a hard time.
Yeah.
So
that a different.
I just happen to be dealing with one right now. He's super nice though. We've become friends now. I did have to tell him to slow down because we Southerners do not understand the accent. He probably thought I was like some idiot.
You speak very fast there for you for the most part.
Sure. Like, whoa.
So let's
slow down.
So let's talk about this. So let's kind of go through this. So if somebody's buying a note, they need to get a policy, a forced place. Let's say the borrower is not providing policy, and they need to get a forced place policy, and that's going to be run somewhere between 1% to 2% of the value of the house, value of the property, right? If that's the replacement cost there for you. Borrower walks away, leaves the property. We go to foreclose, take the property back. We need to switch the policy that we have. Is that correct? You said?
Not right away. Right away. What you do is you go online and you just change the status from occupied to vacant. Mm-hmm. That indicates it's now a foreclosure. And on some of them, you can change the status from actually forced place to foreclosure as well. And then at that point, liability is added. You can also then increase the coverage amount.
Okay. And then we get the property rehabbed and listed and sold, and let somebody else insure it to that point.
Yes. Now, if you keep it, if you decide to rent it, at that point, we need to switch it over to a real estate investor policy.
Okay. Potentially 2 to 3 different policy changes depending on what your long-term strategy is.
Exactly. Yeah. And it's not as cumbersome as it sounds. It really
is. It's pretty easy to jump online and change things and make notices and just kind of update people. Now, one of the things with if rehabs are being or properties are being improved, obviously square footage added or properties updated and appraisals come into the factor. It's always good to provide that to the insurance carrier as well too, to help out with the cost of what's being insured, correct? For the number amount.
But you don't actually need to provide that, but it is a very good idea to keep it in a file on your computer or whatever, because if there is a claim and there's any dispute in the amount of the settlement, you have that. And that is very good evidence, as to not only what the condition of the property was at the time of loss, but what the appraiser valued it at.
Mm-hmm. Are there any properties as far as values across the country? I know we've seen a big increase in appreciation in most markets out there, but any value of a property that really doesn't make sense to get an insurance policy on something more than you need to self-insure? I know that we ran into some issues when we were buying really cheap houses in Detroit.
Yeah.
You know what I mean? Or in Ohio, that it just didn't make sense if we had to repair it and had a $5,000 deductible. It just made more sense to self-insure.
Oh, absolutely. And definitely. So I would say, if let's say you've got a house, you bought it for $25,000, your deductible is $5,000. And let's say your policy has a coinsurance clause in it. That means, you're only, it's going to deduct that coinsurance from the claim, and it's going to be the same amount as the amount under the replacement cost. Well, you're going to come out negative. You're not going to get anything. So you might as well not even put it on there and make the claim, because then you keep your claim history clean, and you don't go through the rigmarole.
What do you see about history claims? As it happens, obviously it's good, but to be taken care of, but also too, that's why you have the $5,000 deductible, keep a lot of the little small petty things off there unless it's something major, correct?
Right. Yes. But again, it depends. You have insurance to protect you and to make you whole. So, don't be afraid to use it, especially on these reporting form type policies, these master policies. Your spread of risk is bigger. So one claim on one property is not going to have the impact that it would on your homeowner's policy.
Mm-hmm. Now, have you seen any of the major firms where they've stopped covering new property and a new we were getting insurance on the house, and the previous insurer didn't want to insure anymore in Texas and other parts of the country. Have you seen that happen?
Yes, particularly in the homeowners market. Yeah, we've seen it a little bit in the commercial side, but not as much as we have on the personal line side.
Good stuff. Questions from you guys and gals out there for Beth here. You can tell she is a wealth of knowledge and wealth of experience out there. What's the most amount of properties you've seen on a master policy with an investor before, Beth?
I've got a few that are into the 4 figures now.
Wow.
Yeah. Then one of them, he started with 3 back in 2017. So that's been fun.
Yeah, that has been a lot of good growth. Was he buying apartments or buying rentals or buying notes? What's kind of been his focus?
He started in notes. Yeah. Yeah. So he's grown quite a bit.
Good stuff. Good stuff there.
Yeah.
Once again, guys and gals, best way to reach out to Beth there is her email's on the screen. If you're listening to this, it's direct number. There's 972-342-4280. Anything you dislike about the industry?
No, I actually love the industry. It is never boring, believe it or not. I know that's going to be hard to believe. I never know it all. There's always something to learn. And the 2 days are never alike. So it's fun. It's always a challenge. But I have a question. I got this question just now, and I figured out how to access it. And it says, I apologize, I'm a little off your subject. We have received so many different opinions from insurance brokers, attorneys, land trust companies on how to properly insure a property that is held in a land trust. How would you advise your clients to do it properly? Thank you in advance. Okay, so a land trust, that's a contract for deed, correct?
No, it's just it's not a contract for deed. Basically, they're holding the property titled in a land trust. It's like not a deed of trust. I mean, it's not held in an LLC or an S corp. It's held in a trust. How are they insuring it in a trust, basically?
Okay, but is their name on the deed? That's my question.
Well, the trust company, basically a land trust can be created pretty easily, basically 2 pieces of paper to create a land trust in a lot of cases. And a lot of investors will create a land trust so that the beneficial interest in the trust is transferred versus having to go file a deed of trust, transfer the ownership. So let's say Joseph and Richard have a property that they title into this land trust, and then they sell the beneficial interest of the trust off to somebody else versus having to change the name. So the owner of the property might change, but they ask for the title it still shows, like, say, the 123 Main Street Trust, basically.
Okay, so Joseph and Richard, I'm going to say that is going to be an attorney question, a real estate attorney question. I wouldn't trust that. I mean, that's legal. I wouldn't trust that with your insurance brokers. I would go to the attorneys.
Okay, cool. Yeah, I mean, the value of the property is still the same in a lot of cases. You're able to pull that up. It's just be different on who the insured is. So if you had to,
right. Yeah. So who's going to be the named insured? Who has the insurable interest? That's the question.
Right.
And without having, more details, who's a member of this trust? What's the I guess path of this trust? Do they go from this person to this person to this person, or what? And that's how you're going to need, but again, an attorney is going to give you the best advice on that.
Right. I'm not a big fan of land trusts, especially in the note business, because to really do any type of refinancing or selling, a lot of times, most title companies are going to ask you to pull that property out of a land trust to put it into a traditional LLC of some sort so that they can get it financed or get it insurable. So maybe getting it insured before you put it in the land trust and then keeping it that way might be the better route. But like Beth said, I would agree. Talk to your local attorney in that state and get a better opinion on what you're doing before going there. And I think it's one of the big things I see. I have a story. An investor buddy of mine bought a property in Florida. They were all excited about buying this beautiful property, but they never checked the cost of insurance.
Oh no. In Florida.
Florida, on the water as well. They closed on it, then they called to get the insurance after closing on the deal. and that over the last 6 months, that insurance has eaten up most of the profits because it's taken a while for them to foreclose on the asset.
This might be my client. I have a few that have done this in Florida.
Okay. Yes. This guy's out of Delaware. He's one of the main investors out of the properties in Florida, but he's out of Delaware.
Oh, we should talk after.
We should talk after, right?
I felt so bad with the one I'm thinking of. I'm like, okay, sit down, because this is the best I can do.
Right, exactly. Yeah. Well, that's the thing is, one of the things we tell people, like, listen, make sure you're calling before you close on a deal. Make sure you find out what the insurance is going to cost you. A lot of people will forget and do it at the very end in the note space, but it's always better to call, get the FPI put on first, so you know what it's going to cost you, and then go from there. And then you can always cancel it back once proof is provided, and like you said, get a full refund back on what was provided. So pretty easy. How long does it take for folks to call and get a policy set up on a forced place policy or traditional policy? Pretty quick. It's
pretty quick. But again, it goes back to that. It depends, if it's, let's say you call me, you've got 5 properties that need the insurance, 15 properties total, they're not in Florida. That's easy. I send it off, those I can have a quote for you in 24 hours or less. Again, it just depends. Some of it we can underwrite in our office, and those are really quick, but it depends. Some of these out of the box ones take a little bit more work. And so it might take a week or two.
Ugliest property issue you've seen on a property that you insured? You see any ugly horehouses, black mold throughout for paper or for the wallpaper? What's maybe the worst, ugliest property you've ever had to pay a claim on?
I've seen some ugly ones. I've seen some really nice ones too, but it seems like, in the note space, you don't always know how the people are living and really in any forced place situation that can be the case. And there's been some, extensive water damage that has been there for a long time. It looks like squatters have been living in there. You've got growth and trash and debris, and it's sad. You think, oh my gosh, people actually were living there, because you see their like fast food trash everywhere. And it's a sad state.
It is a sad state. Question for you: living here in Texas, do you see a difference in the cost to insure in Houston with them being hit so hard with floods?
Oh, yes. It's a tiered county. Yes. Okay. Yeah. So anything that's a tier 1 or tier 2 county, so that means, touching the coast or touching the county line of a county that touches the coast, is always going to be rated up. That's just the way. So yes, Houston, all of Harris County, all of that, the coastline of Alabama, Florida, all of Florida, doesn't even matter if you're on the coastline. They consider the whole state a tier. I have people say, but we're in the middle of the state. I'm like, they don't care.
You got sinkholes. If you're in the middle of Florida, you got sinkholes to deal with.
You do. And tornadoes are spawned from hurricanes. So it's just the way it is.
That's just a normal another day in Orlando where they're 3 o'clock, 4 o'clock rain shower they have every day.
It's beautiful. With some of my investors, I've recently added a few new carriers, but for a while it's just like, look, and these were folks that are doing buy and holds, not forced place. But it's like, I'm gonna send you, get your pin out. This is where I'm gonna send you, because this is where you need to go. They will be good. They're competitive, and I can't touch them. So here it is.
That's what we love to hear. Well, thank you so much for coming on Note Night in America here, sharing your knowledge and some stories.
My pleasure.
Insight to this aspect. I think a lot of people don't know the difference in a lot of things. As I get people, what's FPI? Like I did a little video today. I saw that you liked on.
Yeah.
Letting people kind of know a bit of the stuff. But yeah, it's we get, everybody understands, sticks and, all the value of the property, but they don't understand a lot of times that where you're buying or investing can make it a deal or make it a dud in a lot of cases.
That is so true. So I always tell people, and I know I told you this too, Scott, but have your people, have your attorney, have your real estate agents, have your accountant, and have your insurance broker. Have people you trust around you, so you don't have to wear every hat and be an expert in everything.
Amen to that. Well, Beth, you have a wonderful rest of your evening. Let's hopefully we're in still for some warming weather here in Austin, and Texas is hopefully winter has finally said goodbye as we March now, right?
From your mouth to God's ear, because I am over this.
Good stuff. Well, thank you guys for coming out on Note Night in America. If you're watching the replay, make sure you type in your questions in the chat room. Those do get monitored after live, and then always feel free to reach out to Beth there on her email as well. Once again, her phone number 972-342-4280. That's 972-342-4280. Favorite taco or favorite brisket place in Austin, Beth?
Oh, you're just gonna laugh at me. I don't eat meat.
It's okay. There's vegetables.
Okay.
Torchy's got some good veggie tacos.
Torchy's has some good ones. Yeah. I really like that place. It's called Bolden Creek Cafe.
That's very good. That's a really
Have
good
you
one.
been there? It's vegetarian, but it's so good.
Yeah. It's very good. It's very good.
Yeah. Well, we'll have to go have lunch one of these days.
Sounds good.
Salt Lick. It's just down the street.
There you go. Exactly. All right, Beth. We'll take care. We'll see you later. All righty.
Thanks, Scott. Take care. Bye-bye.